Dear viewers, very good morning. Now I discuss some issues related to banking sector. This topic is Accounting Standard 30, Financial Instrument Recognition and Measurement Implementation. Issues of banking. This article attempts to discuss the major points of divergence of the standard from extant RBI guidelines and some issues related to interpretation of the standard. Divergence with extant RBI guidelines, initial measurement of fair value. As per Account Standard 30, except for short-term receivables and payables with no stated interest rate, that is, and affected discounting is material. All assets and liabilities have to be recognized at fair value. This is in divergence with extant RBI guidelines that require initial measurement at cost. Valuing liabilities at fair value on reporting dates. As per RBI guidelines, liabilities are always carried at cost and there is no question of marking the liabilities to market value. But under Accounting Standard 30, an entity can choose to take the mark to market gains or losses on liability to profit and loss account by the following means. A. Classifying the liability as held for trading HFT, designating the liabilities as at fair value through profit and loss subject to fulfillment of certain conditions. Then valuation of investment in HFT category. As per RBI guidelines, investment in held for trading category HFT are to be valued at cost or market price, whichever is less. Based on the principle of symmetry rather than prudence, and requires valuation of each security at its market price on reporting dates. Accounting of valuation gains, losses of investment in AFS category. RBI guidelines require the recognition of mark-to-market losses and available for sale AFS category investment in profit and loss account itself. There is no question of accounting of mark-to-market gains as per RBI guidelines. But as per AS30, mark-to-market losses and gains of investments under AFS category are to be taken directly to an appropriate equity account, say investment revaluation reserve account, and profit and loss account is not affected by such valuation. Then comes amortization of investment in HTM category. RBI guidelines allow amortization of premium, that is, and not discount, in the case of investment in held to maturity HTM category. Again, the concept of prudence. RBI guidelines do not specify any particular method for amortization, but most banks follow straight line method of amortization. But under Account Standard 30, both premium and discount of investment under HTM category are required to be amortized using effective interest method. provisioning for non-performing assets. As per RBI guidelines, provisioning requirement for impaired financial assets to be recognized in profit and loss account is a fixed percentage depending on the category of NPA, substandard, doubtful losses. And a security status. But as per Accounting Order 30, the loss to be recognized in profit and loss account will be the difference between the assets carrying amount and the present value of estimated future cash flows, excluding future credit losses that have not been incurred, discounted at the financial assets original effective interest rate, that is effective interest rate computed at initial recognition. This is the end of the article. Viewer, if you like this video, then subscribe, share, like and comment.